Hey everyone, it's John Pocoroba with Rain King LLC, and it's time for a general market update. It is Sunday, March the 12th. Again, this presentation is for educational purposes. I'm an amateur individual growth stock investor. So a lot of happenings in the market this week, a lot of news-driven activity. We're going to take a quick look at the market internals. We'll look at the pullback in the indices and ask ourselves, is this normal? And a couple of questions. Is the train coming in on time and picking up passengers? Or did the train break down with an engine failure? Or has the train completely gone off the tracks? And we'll summarize some scenarios and what to do going forward. So some market internals. This is the New York Stock Exchange net new highs, new lows. This is concerning. You know, we have a very, very sharp drop in the increase of net new lows. Not a good sign. These are the advanced decline line for the New York and the NASDAQ. As you can see in the box, the advanced decline, which was doing very well, has really, really reversed with the new information that the market has received this week. And the market is adjusting to that new information. And you can see again in the NASDAQ's advanced decline line, some serious deterioration. Last week, we talked about trends and bull bear markets, and we'd already talked about it was a very news-driven market, and there were things on the scale that were bullish and things on the scale that were bearish. This week with the SVB bank failure is a big piece of uncertainty the market, fear brought into the market, and the markets are reacting to that. So let's get into the pullback and take a look at what we see today. So this is what we did a week ago. A week ago, we looked at where we were when we had about a 6% pullback in the S&P. And though that was still considered normal at the time, we said, boy, we are right around at the limit of what we can consider normal. And I raised a couple concerns last week. The first one I raised was I was very concerned, I don't know about very, but I was concerned about the sharp decline in New York Stock Exchange stocks above the 200-day moving average. And that sharp decline from 77 to 58 in only 3 weeks was pretty sharp. That was concerning. And I also said I was concerned about an expansion or an acceleration of new lows on the NASDAQ. So where are we today? Okay, here's the same chart. The New York Stock Exchange percent of stocks over the 200-day is now even worse. It's only 43%. So that is deteriorating even further from where we were last week. And we look at the pullback, you know, the pullback now has gotten to be 8.3%. It really doesn't look normal anymore. We've broken some trend lines. We're really not in the position that we'd like to be. If the market is going to really reverse itself, it needs to do so this week amidst all of this uncertainty and news. So at least we might be going down to test the previous lows. That's possible, or it may become worse. Well, we have to stay flexible. So this is a chart of the NASDAQ composite. And I've just shown a measurement of the decline. This is a 9.6% decline. You know, I think we used to always go back and say, remember in bull markets when a 10% decline was an intermediate correction? 10% declines in a bear market can be, you know, normal in the sense that they happen all the time. There's a lot of volatility. I don't like the last 2 bars for the NASDAQ. They can tell you that they're wider range, closing at the lows. That's just a sign of some fear coming into the market with the financial bank situation, et cetera. Also, which is really concerning, is the net new highs on the NASDAQ index. And you can see that the net new lows are accelerating, not what we want to see. And you can see we're over 200 on the net new lows. We haven't had those levels since late December. So this is not a good picture at the moment. Now, last week we shared this information from Sentiment Trader, which talked about the odds that the bear market low was in, if you can stay above the 200-day moving average for a certain number of days. So this concept looks to be tested. It looks like we're going to test that. And the real question is, have the odds changed with all this new information this week about a hawkish Fed, and then the financial banking situation? A lot of questions if it's going to spread or it's contained. That remains to be seen. So the blue are the checkpoints we wanted to look at in measuring, is the pullback normal? We said if we see the indexes try to rally, but under the surface we see some bad signs, that would be negative. The rally in the index lasted only about 2 days, and it really got shut off in its tracks. And you say, did we see poor breadth? Check. We did see poor breadth. Our deteriorating new highs and increasing lows? Check. We saw that. And we just said this is a bad sign. So we're not getting the kind of feedback we'd like to get, but we just have to, interpret what we see. We also talked about trend. Did we have one? We had thought the follow-through days and subsequent follow-through days were really, really positive, and they are. But all of these signs have taken a turn for the worse this week. The pullback, we said 6% was normal last week, but we said any further and we might roll over. We mentioned just a little while ago, we are at 8.3% on the S&P. So it's no longer looking normal. And then we looked at leading stocks. And last week we said the semis and travel and airline and gaming were still strong. There are some pocket names, but it's getting thinner and thinner. I think NVIDIA, Wynn, Las Vegas Sands, and Booking are still, I'll say, holding up. But some other ones are starting to break. The payments and builders are become under pressure. We mentioned that last week, and we talked about earnings reaction gaps. Some were working, some were failing. So for every one that's working, like First Solar or Axon, we have others that have really started to roll over with Okta, New Relic, Airbnb, AI. So again, we had the Powell speech this week. We had a jobs report, and we've had the banking Silicon Bank problems. So let's talk about a couple of scenarios as I see it possible. And again, this is just theoretical scenarios. Next Tuesday is the CPI report, and 50 basis points are anticipated for the March meeting. Let's assume that the CPI hits the number and the Fed raises the 50 basis points. That would be expected and probably not much market reaction. Another scenario is the CPI number starts to cool off, inflation starts to come down, but the Fed still raises 50 basis points. That would really be a sign that the Fed still has its foot on the accelerator, and that would be bad for the markets. The next is the CPI cools off, inflation comes down, and the Fed backs off and only raises 25 basis points. That would be a little unexpected, and the market might rally. Now, if the CPI comes in hot and inflation is starting to tick up again, the Fed is going to be in a really challenging spot. They're going to have to raise rates to try and tame inflation, but at the same time, they're starting to break things within the financial banking sector. So it's a really, really tough spot of what they would be able to do next. So the bank failure, we don't know what's going to happen next. I know there's a lot of people speculating this and that. I think you just got to let it unfold day by day and protect your portfolio. Now, try to avoid hindsight bias. People say Silicon Bank failure equals great financial crisis again. I think we want to not get in front of our skis. That's a possibility it could happen, but it hasn't happened yet. Let's see what happens and how this unfolds and how the Fed's going to approach not only interest rates, but also support for the markets if they're going to come in and try to calm some of the uncertainty and fear that's brewing in the markets around the banking sector. So coming back to the summary, the question is the train. Did the train come back and pick up passengers? Well, it tried. It got support last Friday, and we got support looked good, like we're picking up more passengers for a bull move. But then it's quickly, in 2 days, it turned around very, very negatively. Now, did the train actually break down? I would say yes, the train has kind of stopped on the tracks. The market internals have rapidly shifted for the worse. Doesn't mean we're completely dead. The market needs to make a real convincing stand this week to undo some of this damage. And one of the signs I would be looking for is some really strong breadth days to come back into the market. You probably say that's a really low odds of happening, but if we got a couple of 80, 90% up days in the market, that would be a really good start. So I wouldn't completely rule that out. You never know with the markets. Now, is the train of wreckage completely off the tracks? I would say objectively, not yet. Now, this week will be very revealing if we get some support or we continue to cascade lower. So the bottom line is we're in a trendless, news-driven market, and there's still lots and lots of uncertainty. And remember, cash is a position. You want to protect yourself. You know, there's certainly not a favorable environment for bulls. So that's our summary. I wanted to give you a little bit of information, a few announcements of what's next for myself. Saturday, March 25th, I will be speaking at the Molly's World group, a California group. I will be doing a talk on a model stock simulation of Shopify from 2016 to 2021. I'll tweet out some information when registration becomes available for that, but maybe you want to put it on your calendar. Also, Richard Mogulin, graciously invited me to do a podcast, which was really, really fantastic. We talk about balancing trading with a full-time job. We talk about market studies, model book stock research, and we also talk about earning reaction gaps, which leads me into my next bullet, which is earnings reaction gap research study and workshop. I've teamed up with Ticker Monkey, Jason Thompson, a year's worth of research I've done into a study on research and overlaid that with Jason and looking at buy strategies. So we're offering a workshop that actually gets really into the characteristics of the big winning gaps. And most importantly, all the data we gather tries to give us edge, and we try to reveal a series of buy strategies for day traders, swing traders, and position traders. So the workshop, I won't go through every bullet on this slide. You can simply stop your video for a moment, but it's very, very comprehensive. We cover everything from earnings surprise. Jason gets into some candlestick combinations. We talk about his expertise in Fibonacci. We get into some, basic buy strategies for someone who is starting out in their trading career, wants to trade gaps. But we also get into advanced extended hours trading. So advanced traders will see some really, really interesting information on how to trade on an advanced level in the after hours for a gap situation. And if you participate, you'll get an entire copy of the study for 300 pages. There's over 7 hours of instruction, and the recordings would be available. Now, we're going to open up registration to this to the public on Tuesday, March 14th, starting at 6 a.m. So what I ask you to do, if you're interested, there's more information about all of this at tickermonkey.com/ERX Gap Workshop. If you go to that webpage, you'll see there that there is a 7-minute video that I give that talks about everything in the workshop in detail. And where I have 2 offerings around the workshop. One is a kind of a VIP executive level workshop, and then we have the regular workshop. And you have a choice of which one you want to participate in. So with that, I hope you at least check out the website to see what it's all about. We're pretty excited that we haven't seen this type of research and workshop put together yet. So that's all the time for now. It's March 12th, 2023, and that's the general market update. And there's the information if you'd like to reach out to me. See you at the next update.